Hi everybody, welcome to another video of what's moving the markets. We're going to look at the impact of the TSMC earnings, how Nvidia reacted to that, what the market is doing in terms of the forward guidance of the interest rates, and how the fixed income, the bond market is reacting to it. So we'll talk a little bit about interest rates, and overall we'll be discussing the different sectors and how they are expected to adapt to what is expected to unfold in the coming days and weeks ahead. So AI oriented earnings discussion, inflation oriented rates discussion, and in that context, we'll be talking about the path forward. So let's start off with a sector wise review. And this really gives us a lot of insight into what is happening. So there is a move towards defensive sectors, right? Financials are continuing to do well, and this is no surprise for us. We talked about this, that even though the Fed started with a 50 basis point cut, the future cuts are expected to be much lesser, if at all, depending on how resilient and stubborn inflation continues to be, along with how strong the labor market continues to be, which both of them are showing signs of. Inflation is stubborn, labor market is strong. So, as expected, we are probably not going to see very large cuts, which obviously is good for the financial sector because interest rates stay higher for longer, which is good for the profitability of the banks. But at the same time, higher interest rates mean that the weaker areas of the economy, the small cap stocks, which are heavily indebted to these banks, will have to pay these high interest rates to the banks, and many of them might even start declaring bankruptcy because they're already in losses. Their equity is getting wiped out, and that is what explains this move to defensive sectors. And you're seeing that there is a continuous inflow into defensive sectors. So we need to understand that the market is actually well positioned in terms of financials and industrials, and of course the defensive stocks also are doing well. And within industrials, you've got your defense sector, which is benefiting from the military conflicts. So that is very well positioned, and obviously materials are also very well positioned because of both, number one, the technology play, the AI play, which we've talked about many times, that because the cash is flowing into the data centers, and then from that it is flowing into the utility companies, and utility companies need to upgrade their infrastructure. So obviously there is a material play because of that, and because of defense and industrial equipment coming in, the material sector is benefiting as well. And today we will talk about the Chinese economy a little bit as well, that what's happening over there and why bad news is actually good news, because of the stimulus that is expected. So we'll talk a little bit about that towards the end. But one thing I want to highlight, and this is something I told you earlier as well, that energy is volatile, right? It goes up a lot when there's bad news, in terms of an attack on the oil facilities. Then it crashes when there is a news that, oh, we're not going to attack the oil facilities. So this is something that you can't really invest based on. It's very, very volatile. And this is something that I think one should shy away from. The second thing that I want to re-emphasize, which we have discussed many times earlier, is technology. That even though you see a very good result of TSMC, and that of course is impacting Nvidia positively. I have been focusing on a cautious stance that you should have towards this sector, and I'm going to reiterate that today. I'm going to be sharing some technical analysis with you today. So TSMC had its earnings result come out, and it was very good, which obviously created a positive impact on Nvidia. But technically, what I'm seeing is that around 140, which obviously is 1400 before the stock split was there, the 1 to 10 stock split. So, I mean, think about it, right? I mean, Nvidia has been running up from 100 to now it has reached 1400. And there has been selling pressure at this level earlier. You see that selling pressure again now. This is called a double top, right? And you can see that there is divergence in terms of the price going up, but the RSI making lower lows. And if the RSI takes a hit here, very strong probability that Nvidia is going to correct to, let's say, maybe 115. So that's around what, a 20, 25, 30% correction. So looking at this possible pullback, I would suggest that, again, not investment advice, but this is what I see, that maybe you guys should be taking an exit here. And this, by the way, can be confirmed by the relative rotation graph, which shows that Nasdaq is weakening. And this is something we've been talking about for the past couple of weeks as well, that if you see in the relative rotation graph, you can see the industrial and the financial sectors getting strong. Financial because of the higher interest rates for longer, and then the industrial because of the defense sector, and the materials are doing well, but the technology sector is weaker and weaker and getting weaker, and that might now start to catch up with stocks like Nvidia. So I would definitely advise caution here. Not in the long term, of course, this should be treated as a re-entry opportunity, right? So once it comes down, once it pulls back, you could start re-entering. So let's say if you have a budget of $100, right? Maybe you could put in a 20 at 115, and then if it corrects to even lower prices, you could add more, and if it goes up, you could start booking profits. So you could start getting re-involved once it gives you a better rate. And I know what I'm saying is contrary to popular opinion. Nobody wants to say that, oh, let's say Nvidia is going to correct, because obviously people took exits at 800, 900, and they're very sad that it has gone up to 1400. But I have been riding this train, and I'm still trading. So it's not like I've missed out on it. But what I see, I'm just calling it like I see it, that there is bearish divergence. Clear to see, the price is going up, the RSI is coming down, number one. Number two, the double top is there, right? And number three, I mean, if you just look at this candlestick pattern towards the end, it's hard to call what the name of this pattern will be. One could say it looks like a bearish harami, right? Which again is a sign of a possible pullback coming in. So this is what I would say. And where should you put your money? With China, bad news is good news right now. So we'll talk about that shortly. That why bad news is good news, and how your stimulus in China is going to be good for the overall economy of China, and how that then is going to drive up demand for basic materials. But before I get into basic materials, let me just reiterate something which I have been telling you for weeks. Gold, gold, gold. And I'm still saying gold. And I'm not saying gold in terms of speculation on the price. I'm saying gold in terms of producers, right? Mining companies. And I mean, if just look at the stocks of gold mining companies, they have been going up and up and up. and that is expected to continue, right, because of multiple factors. There's obviously your geopolitical issues which are causing investors to add gold. Central banks are adding gold, and that I believe is a more longer term trend. Even if your conflicts sort of get de-escalated in the short term, partial de-dollarization is a long-term trend, and it's not going anywhere, right? I mean, the BRICS are not going to stop. China, Russia are going to continue to replace their foreign currency reserves with gold, and there's a long way to go. So I mean, China probably has just what, 5% of their foreign currency reserves as gold, and a lot more in terms of dollars. So we feel that a lot of that is going to be replaced. So 3000 might still not be high enough for gold. You could see it going up maybe to 3500, even 4000. And it's not even about gold price going up, right? It's about higher prices. Even if it stays high, the profits of the gold mining companies are going to be huge. So you could just play on the gold mining companies, and you don't even have to just buy and hold, right? I mean, you could actively trade them. You could keep buying them if they come down. You could keep selling them if they go up. So you could play on that volatility, which is something you can do for the mining companies of basic materials as well. And I have been telling you about companies like Rio Tinto. Now, I'm not saying go specifically for this company. You can if you want to. Again, it's not investment advice, but the point is that it's just an example to explain to you that how you can get exposure to these commodities, not directly by speculating on the price, but through profitable mining companies which benefit from the higher prices. And these mining companies are relatively volatile as well. Some of them have more than a beta of 1, so you could really benefit from active trading as they come down and go up. And it's not much of a risk to buy into these companies within your portfolio, considering that what's happening in the other sectors, right? I would definitely stay away from energy, because you really don't know what's going to go on, right? I mean, if there is an escalation into the oil facilities, I mean, you could see something which could be really, really bad. And it's going to be really bad for the market. Tech, especially, everything is going to crash, right? Whichever stocks are highly overvalued or at trading at very high PEs, they could come down a lot. So I would advise a cautious stance. Gold is good, and basic metals are good, subject to a Chinese stimulus, right? So now this is something I really want you to focus on. That for China, like it has been for US many times in the history, that bad news turns out to be good news if your fiscal and monetary stimulus is expected to counter that bad news, right? So we did get some bad news from China, that the recent economic data that has come out is little bit cooler than expected. So it's not very bad news, it's just a little bit bad, which easily the government and the central bank can offset with a positive fiscal and monetary stimulus, which they are looking likely to give, right? So if I were to take a risk on something, in addition to gold, obviously gold is there, right? I mean, I don't have to tell you every time that gold, that's just there. But in addition to gold, if I were to take a risk on something, I would go for basic materials, right? And I would choose within basic materials those ones which are specifically used in renewable technology, right? So stainless steel, copper, maybe you could even do silver if you want, lithium definitely, right? So keep an eye on what the Chinese authorities are expected to do in terms of fiscal and monetary stimulus, because that is going to be very, very good for commodities. And again, guys, like I always tell you, please don't speculate on the price. Take an exposure on solid companies which are producers of these commodities, which have thousands of employees, billions of dollars worth of turnover, very stable, very large companies. And don't just buy and hold. You can actively trade, buying in small portions. You have to do your money management very carefully, right? So maybe at some point I'll do a little discussion on what money management is and how you have to break up your position into smaller parts and ease into the position and not buy all at once. Right. So, what is the outlook? Yes, tech is good, but with caution, because we've been seeing Nasdaq weakening on the relative rotation graph for weeks now. We just saw a double top in Nvidia at 140, right? RSI is weakening. Possible correction on the cards to 115. What I would definitely say is that you guys should definitely book your gains and slowly ease back into the position as the pullback is there, right? But overall, in the long run, it looks good. It looks very good. Of course, the whole AI sector looks good. The recent news that OpenAI might be expanding their paid customer subscription. So basically, right now, what's happening is like application layer plays like OpenAI and all these other applications, AI applications that are there. The amount of money they're generating from their subscriptions is not enough to pay for the data center cost and the utilities. So the cash requirement is being filled by fundraising, right? But that is of course not a sustainable model. Eventually you have to bring your own cash flows, and the model has to fund itself, which it will, because we are seeing that more and more people are willing to pay for this subscription, and now they're looking at different sectors, corporate users of these type of products, that how people, let's say in consulting firms, thousands of consultants can use ChatGPT and pay a lot of money for it, right? So the cash will continue to flow into the application layer, such as Microsoft and Google and Meta, and eventually it will trickle down to your semiconductor players like Nvidia, etc. And then of course through the data centers to the utilities, and then through the utilities to renewable tech, which will obviously flow into materials which are used for solar panels, for wind turbines, for just electricity transmission. Batteries is a key play. So we've been talking about all of this, that yes, it is there, long term potential is very, very good, but you have to understand that it's not just fundamental analysis, but it is technical analysis that you have to also use. So it is facing a sort of technical resistance at 140. There is support at 115, so you should definitely take that into account. Commodities play, of course, I love gold. I've been talking about it for weeks now, that that is of course number one. Number two, basic materials, copper material stocks like Rio Tinto, etc., and many others, right, could benefit a lot from potential Chinese stimulus, and that is something you should keep your eye on. Monitor China's stimulus potential. Bad news is good news, and we got a little bit bad news, so we most likely are going to see strong fiscal and monetary support coming in from the Chinese authorities, right? So that is something which is a key factor to watch. And as always, if you found it useful, please like, share, and subscribe. Leave your comments, and see you next week.